In questo podcast parliamo di come gestire al meglio i tuoi investimenti, ma la vera forza dell'investimento è il risparmio, soprattutto quello che puoi ottenere senza rinunciare a nulla, abbassando i costi della tua bolletta, dell'assicurazione auto, del mutuo, del conto in banca. E il modo più semplice per farlo? Beh, vai su facile.it, confronti le tariffe di assicurazioni, banche, operatori energetici e trovi le migliori per te, il tutto in pochi minuti. Puoi fare tutto online, ma se hai bisogno di una mano, ci sono oltre 600 consulenti pronti ad aiutarti, sia al telefono che di persona, nei facile.it store presenti in tutta Italia. Insomma, facile.it confronta, tu risparmi e inizi ad investire.
Whatever the occasion, effortless elegance is right this way. Because Hilton brings you new ways to stay courtesy of the Nomad London. And it doesn't stop at award-winning dining in a space draped in velvet and illuminated by vintage chandeliers. No, this day goes beyond with unparalleled personalized service and attentive hospitality. Oh, and did we mention the Nomad London can be booked using your Hilton Honors points at Hilton.com? Hilton, for the stay.
Welcome back to The Bull, your personal finance podcast. Happy second birthday to all of you, dear friends and listeners of the show. After 2 years and 220 episodes, I couldn't imagine a better guest to celebrate this milestone with. Someone who has had one of the most significant impacts on how I understand personal finance. Author of the hugely popular blog of Dollars and Data and the global bestseller Just Keep Buying, Nick Maggiulli has become an essential voice in the world of financial education, not just in the US, but internationally. And as his name clearly suggests, Nick also carries a bit of Italy in his DNA, so we are doubly proud to have him here with us today. Together, we talked about the key ideas behind Just Keep Buying, his take on investing today, the importance of the non-financial side of finance, and much more. With great excitement and no further ado, here's my conversation with the great Nick Maggiulli. Dear Nick, welcome to my podcast, The Bull.
Thank you for having me.
It's a great pleasure and honor to have you here. It was July 2023, the first time I talk about Nick Maggiulli in my podcast when I released a 2-part episodes about 10 rules to be successful with your money and investment on something like this. And the bedrock for that episode was obviously Just Keep Buying, a massively successful book about personal finance and one of my favorite books of all time. And for the very few here who don't know you yet, please tell us what your background is and how did you get into personal finance?
Yeah, so I was an economics major in college, and after that I went into something called economics consulting, and that's a little bit different than management consulting, which many people have probably heard of. And economics consulting is different because it's very analytical and backward looking, while management consulting is trying to look to the future, increase the profit of a business. Economics consulting, also known as litigation consulting, is just looking backward. It's saying, hey, this thing happened. There's now a lawsuit. There's a legal case, and 2 companies are suing each other possibly, or the government's suing a company. And so we need to figure out what happened and then analyze that information and go from there. And so for me, I was really because of that industry, I got really into programming, like computer programming. And as a result of that, I already kind of had a passion for personal finance. And so I kind of put them together, and that became what Of Dollars and Data is, which is, my blog. And then I was writing about it for many years. And as a result of all those writings, during COVID, I said, hey, I need to take advantage of this. And so I decided to take some of my best work and compile it into a book, which became Just Keep Buying, which has been out since April 2022, and the Italian version comes out on June 27th. So of this year. So it's taken a few years, but I'm glad we now finally, my Italian last name, I will now have my name on an actual Italian book, which is incredible and just so fun for my family, especially.
I love that we have a little bit of Italy in the personal finance ecosystem. Of Dollars and Data is a fantastic blog, and I think you found a great sweet spot between personal finance advice and data. In fact, whatever you say is always backed by numbers, which sets your contents apart from many others on personal finance. Did you expect it to become what it is today?
No, not at all. I had no clue that any of this was going to happen. I mean, I wrote for 3 years where I didn't make any money, so I thought it was just going to be a fun hobby for a long time. And, then I started monetizing, the blog started to grow. I didn't think I'd write a book. I eventually, just the way the world turned out, it kind of forced me to do a lot of this stuff without me even realizing it, right? I think COVID especially was a turning point for me because I was like, I'm trapped inside. I normally would be going out with whoever I'm dating, or I'd be going out and being with friends or something. And because I couldn't do any of that, I was like, I need to use this time. And that's kind of what was the impetus to write the first book. And that kind of forced me to do that. And so then I kind of just kept going from there. And so it's just been a fun ride. It's been a lot of positive surprises in a good way. And so just, taking it a day at a time from here.
How many articles have you written so far?
I think I've written over 450 now. Yeah. So it's
Crazy.
one a week for almost 9 years. At the end of 2025, it will have been 9 years of writing. I just write one a week. And that may not seem like a lot, it's just one article a week. But if you do that and try and really put in time, 5 to 10 hours per article and make them really good, then it adds up over time. And then it ends up like the book, Just Keep Buying, 70% of that was content I'd already written. And I just took the best bits of it, kind of put it all together, created a cool framework, and then put it out there. So I think that's the thing. It's like you have to do something for a very long time to start seeing real results. And so I wasn't expecting any of this when I started, but it's just gotten better with time.
It's my non-negotiable ritual every Tuesday. You release it in the morning in the US, so I read it after lunch here in Italy. It's my non-negotiable appointment every week.
Oh, I truly appreciate that.
Thank you so much for delivering so much content. Let's move to Just Keep Buying because every page of that book is really full of wisdom. If you had to summarize the central philosophy in a sentence, what would it be?
So in Just Keep Buying, this is what I call the mantra. And the mantra is the continual purchase of a diverse set of income producing assets, right? So there's like kind of 3 things there. The first is the continual purchase. And we can talk about this more, but it's just you keep buying over time. And that strategy, of all the strategies that you can try out there, that is the simplest strategy that has generally outperformed just about every other strategy out there, right? Just keep buying over time, right? That's the first one, the continual purchase of a diverse set. So that's now diverse. That brings in the diversification. So you're not just buying like only one country stock market. You're not just buying just one individual stock or a bond, right? You're buying a diverse set of income producing assets. And that third part is about owning assets that create income and that pay that back to you. It doesn't have to pay to you directly. It doesn't mean like you have to only own dividend stocks, for example. As long as they are creating income, even if they're reinvesting that income in the business, that's where it is. So in terms of income producing assets, that's stuff like obviously stocks, bonds, real estate, farmland, royalties, small businesses. Like there's a lot of things that are income producing. I don't think everything you need to do needs to be income producing, but I think the vast majority of your assets, like 85 to 95%, should be income producing assets.
They are assets with intrinsic value, so they don't need to be bought from someone else at a higher price to have value.
Yeah, I mean, so I have nothing against, obviously, like, especially right now, in 2025, like non-income producing assets have done decently well, like gold, Bitcoin, they're all doing quite well. And so I'm not saying you shouldn't own any of those. I think you should actually own some of those, but I don't think it's the bulk of your portfolio because once again, it's like, where's the intrinsic value, as you say, that's related to these things? It's just based on other people buying and selling it. Now, that's not useless, but without the income, without something backing it, it's just, a game of who can I pass it on to in the future. And so it's just something to consider. So I do think, and even then I own both. I own, about 5% of my assets are non-income producing and will remain as such. Even as my portfolio gets bigger, I'll buy more into those over time.
Sure. Through your book and your blog, you helped hundreds of thousands of investors to figure out several typical misbehaviors that are hardly wired into the investor mind when she starts to invest. What are some popular investment ideas that are technically wrong or unsupported by data?
So I'll give you one on the personal finance side and one on the investment side. So on the personal finance side, I think, especially in the US, I don't know the Italian financial media that well, but in the United States, one of these ideas is if you cut your spending, that's how you get rich. Your issue is your spending. It's not your income. It's not anything else. It's because you're spending too much money. And I think when you look at the data, this is not true whatsoever. There is absolutely no evidence to show that spending is the primary culprit in what is preventing people from building wealth. I think for the most part, across the board, it seems to be people just don't have enough income. So that's one of the things. And I've shown that in Just Keep Buying. And in my next book, The Wealth Ladder, which I don't know when that's going to be released in Italy eventually. But that book, I go even deeper on that idea. And I show it even across people, wealth levels. As you get more and more wealth, income tends to just rise with wealth. They're very correlated. So that's the first idea. Cutting spending is not the way to get rich. That's a
So
myth.
it's not the $5 latte that would make you rich.
Yeah, the latte is not doing it. Yeah, your Italian coffee is not the reason you're not building wealth, right? It's income, right? So that's the one on the personal finance side. On the investing side, I think the biggest myth that's out there and that I think is very popular is like, buying the dip, and I should just hold cash and wait to buy the dip. And we've seen this over and over. And it's like, every time there's a dip, you buy, and then the market comes back. And that's fine and all, and it has worked at times. The problem is when you're holding cash to buy a dip, most of the time the market's going to keep rising. And so by the time the dip comes, that quote discount you bought at is probably at a higher price than what you could have bought at previously. Now, I'll give you just one example of this. It's a very extreme example, but it's an example I think that will illustrate it. So I started writing in the beginning of 2017. I remember at the time people were saying, US stocks are too expensive. Like, I remember this was very common. I mean, people say that now still, and maybe they are now.
Every year.
Every year it's the same kind of thing. And maybe they are. I'm not saying they aren't. I'm just saying that was being told to me. I was seeing it out there in the ether, US stocks are too expensive. And someone's like, okay, I'm just waiting for like my moment to buy a dip. So let's say you started saving cash since 2017. You're saving cash 2017, 2018, 2019. 2020, even if you had perfectly timed the COVID crash, right? Remember it crashed in March 2020. The low was March 23rd.
Of course I do.
Yeah. The low was on March 23rd, 2020. So even if you perfectly timed it and you bought on the bottom, the exact day, March 23rd, 2020, that price was still 7% higher than prices that we saw in early 2017. So even if you had this perfect crystal ball of market timing and you just knew, hey, this is now the bottom, and you bought then, which of course that's a major assumption that no one's going to know, and you bought then, you're still buying at higher average prices. And I think that's what happens. People hold a ton of cash like, I'm just waiting for this opportunity. Those opportunities generally don't come, and then as a result they underperform, and they don't see the underperformance because they weren't invested from a long time ago. Now, of course, there are periods where you can perform well if you hold cash and wait for a dip. 1930s is an example, 1970s, the 2000s, right? There are moments where that would have been profitable. The problem is they're so rare that I don't think that is the strategy I'm going to recommend for anybody, because even after 08, 09, the great financial crisis, a lot of people in the United States were like, there's a dip coming, I'm just going to hold and wait. And the market just basically rallied for the next decade or a decade and a half. It's been basically 15 years. And so it's really tough to know those things ahead of time. So that's kind of the misconception about market timing out there.
Yeah, very often people overlook the fact that when there's the opportunity for a dip, generally there's also a mess all around. People are losing jobs, companies are laying off workers, you think the world is going to an end, and now that you can put your money into the stock market to buy a dip. Because typically when the market drops 30% or more, you are most likely to believe that the end of the world has come.
Yeah, exactly. And so that's always the difficulty with this. And it's funny because, there are times where that strategy is profitable, but they're so rare that following it all the other times, you end up being worse off than not following it at all, right? Than just ignoring the strategy. So
There is one among your many brilliant quotes that I love. Could you please explain why even God couldn't beat dollar cost averaging?
it's related to this point actually that we just discussed, which is like I created this experiment where I said, hey, let's say you bought the US stock market over time, right? And you did over 30 years, 20, 30 years. And let's say every time you were in a market bottom, like relative to two all-time highs, like, if let's say there was a high in January and then the market declined to April, and then there was another high in July. I would say, okay, in April, that's where the bottom is. I'm going to tell you right at the bottom so you can save cash. Instead of buying in January, you save cash and then you buy right in April, right? And then you save cash again until the next, decline, the next dip in between two highs. If you kept doing that over time, you would actually underperform someone who just bought every single month. And the reason for that is because of what I just talked about. Buying these dips and waiting for these dips. The dips happen, but they happen on average on higher prices than what you would have bought originally. So like that dip in April could have been lower than January. It could have been lower than February, but statistically, it probably wasn't. So you bought a dip in April. Maybe that was lower than March. So you got a little bit of a deal, but then that dip was still higher than January and February. As a result, you end up paying a higher price. So the dip is actually not a discount, right? As much as you think it is. And so that's the type of stuff that happens very frequently. And if you do that over a very long time, even when you're, quote, God, and when the bottom is, you still will underperform someone who just buys every month and doesn't pay attention to it, right? I think there's another thing we can talk about here, which is like all the time and effort and mental energy spent timing the market and doing all this stuff. Like, do you think you're going to make more, returns trying to time the market or focusing on like what you do in your career and like, it just doesn't make sense to me. All that time and mental energy people spend on this stuff just doesn't add up compared to like working on something that's valuable. Like for me, that valuable thing is like creating more content, doing more research, like putting out more blog posts. I'm going to make far more money doing that than any sort of money I'm going to make by trying to perfectly time the market. And I think that's true of like 99% of people. There are probably 1% of people that can actually time the market and they should do that, but it's hard to know if that's you beforehand. So don't waste your time, basically.
You make more money from 9 to 5 than from 9:30 to 4.
Exactly. Yeah, that's the exact type of thing we discussed. So
yeah, it's crazy. There are several misconceptions that are hard to accept even after you see the numbers. I read the article about even God couldn't beat dollar cost averaging several times because you have to trust it before you really figure out all the stuff. We're simply not made to believe that even with perfect foresight, you can't really beat the market. So I have come to the conclusion that we are born with this die-hard idea to do something more in order to achieve more, while doing less in finance is typically the right thing to do. Do you see any other misbehaviors like this while being exposed to many investors in your daily job as a CEO of Ritholtz Wealth Management?
I think, so I'm not talking with clients themselves. That's what the advisors do. So I work in the operations side. I'm like getting the business to run very efficiently. But in terms of just general, financial misbehaviors or investor biases I see, the biggest one I think is overconfidence. And I've fallen into this too. I've been sucked into certain things where it's like, oh, I'm pretty sure this will do something. Or like, look, oh, this company's only worth $1 billion. Like it seems like every company is $1 trillion company now. This can only go up, right? And then the company, invariably I buy it and then the company just starts declining, right? So it's one of those things. I don't really buy individual stocks anymore, but every single time I've done one of these like individual undiversified things, it hasn't really worked out. And it doesn't mean I've lost a ton of money on it, but it's just like it hasn't worked out. I never put a large piece of my portfolio in there. But at the same time, I think it's just overconfidence. It's very easy to trick yourself into thinking you're right. And once you believe something really deeply, you're just going to look for information to confirm that, and then you're going to just invest accordingly. So you have to be really careful. I try to just divorce or kind of remove my ego from the equation and say, hey, just buy a diverse basket of income producing assets and don't waste any more time on this, right? That's the big thing I do, and I think it's been very helpful. It's been the most successful thing I've done, is just following that principle.
As far as investing in individual stocks is concerned, last week I released an episode backed by the latest Michael Mauboussin paper about recoveries and drawdowns, where he concludes that the typical median drawdown for any stock in the last 40 years is 84%. So it's ludicrous to think you can perfectly time your buying and selling of individual stocks when this is the game you are going to play.
Yeah, I agree. I think it's very difficult to do, and so I don't participate in that. So
how would you suggest thinking about asset allocation over time, especially for people in their 30 to 40s, which is the vast majority of the people listening to this podcast?
Yeah, so I think the typical asset allocation advice is like, take more risk when you're young and then take less risk as you get older, right? And that's fine. It's an okay approach. Like, for example, they say, take the number 110 and then subtract your age. So if you're 30, 110 minus 30, that's 80. So you should be 80% in stocks, right? And 20% in some sort of fixed income or bonds of some sort. That's a fine approach. I don't think it works well with how our lives tend to go. And so I think as you get 30s, especially by 40s, if you have a family or something, I think you need to actually dial the risk back a little bit more, because you have a lot more liabilities you need to take care of. And so things like, making sure you have a larger emergency fund, or making sure any money you have outside of your retirement accounts. In this case, I'm just talking for the US. I'm not exactly sure how the Italian, how the accounts work exactly. But in the US, we have like these retirement accounts. Those can be risky, but everything outside of that, you need to take less risk when you have multiple mouths to feed, if you have a husband or a wife to support, etc., right? All those types of things are the things where you're going to have to make adjustments around that. So I generally say people should invest more based on where their lives are and their situation, more than just any number in their age. Of course, their age matters, but at the same time, you need to think about the risks you're taking in your life, and you want to make sure that no matter what happens, you're going to do okay. And so, of course, it's hard we can't predict the future. There are certain circumstances that no one can predict, and there's nothing that you could have done to help yourself. But in general, I say, if you have a family or something like that, you need to probably take fewer risks. Or if you're supporting your parents, let's say you have elderly parents and you need to support them financially, that's something where maybe you need to dial the risk back a little bit as well. So just something to think about. I think that's the way I think about it. It's a little different from the traditional advice.
So more goal-based and related to your actual needs in your life and to the specific point you find yourself.
Yeah, I think that's the way to do it and think about that. And every person's going to be different. If you're single in your 30s, you can take that 80-20%, 80% stock, 20% bond risk easily. Of course, it also depends on your risk tolerance. If you're a very skittish person, maybe you shouldn't have 80% in stocks. But it's really about learning about yourself. How did you react during previous crashes when you're trying to own a basket of stocks, right? And things like that. So just thinking about those things is what's important.
Yeah, people generally think that stocks and bonds are just isolated components of their portfolio, while your career, your life, your liabilities in your real existence are part of your own portfolio as well, because if you have a stable job, you can be more aggressive on stocks, and the other way around if you are an entrepreneur, for example. So you should consider your whole life to pick a portfolio which is consistent with your actual needs and goals.
Yeah, exactly. I completely agree.
When you talk about a diversified set of assets, I think you mean index funds and ETFs, which are a perfectly efficient way to invest your money at a low cost. As you know, there's a lot of debate about side effects of index investing, the fact that they may overweight growth stocks, make some stocks overvalued, and so on and so forth. Today, that the US stock market is highly valued, Do you think it could be wise to tilt your portfolio away from a market cap index and favor value and international stocks in case a reversion to the mean happens anytime soon?
Yeah, I mean, this is an argument that a lot of people have put forth. Is like, hey, U.S. stocks are overvalued, so I tilt more to international, or I tilt more to value, or something like that. It's a fine argument. I have nothing against it. I think the problem is, at least what we've seen in the last 5 to 7 years, is those valuations can remain stretched even today. Like, while value has had a very slight kind of reversion, it's been very slight. Like, it's still value versus growth. Growth is crushing value and has been for some time now. And so the question is, well, how long is it going to take to revert? And no one knows, right? Like, some could argue this time is different. Like, the world has fundamentally changed. We are more of a tech-based economy than we've ever been. There are more people on their phones, on Instagram, WhatsApp, etc., just spending so much time on there. And that, because the attention is flown to that, that attention is not being spent on other businesses that may be, quote, value businesses. And so there are arguments to be made that this is actually a fundamental change in the economy. I don't know. I'm not here to predict the future. I can't predict the future. But given that, like, this is one of the risks of kind of doing that tilt. And so will there be a reversion? I don't know. I'm guessing at some point. But does that mean the reversion is going to undo all the kind of lead that growth has had over value? I don't think that's necessarily going to happen, but I don't know, once again. So, market cap weighting is a simpler solution to this, and just says, hey, let the market vote. The market's much smarter than me. If the market thinks growth is better than value, that will be reflected in my portfolio. And if that ends up not being true, it'll be unreflected, right? It'll shrink over time if that's the case. And so I don't try to think I'm smarter than the market. I think sending a little, or, quote, tilting just a little bit, is fine. I do some of that myself. I do own some value ETFs. I don't own any growth specific ETFs because I think the S&P 500 itself is a somewhat growth ETF. So I do some tilts, but once again, it's very small. I think sending a little is the way to do it. I don't go, okay, I'm going all in on value or all in on international, because I've done this for a while and those have underperformed, unfortunately, but I'm not changing my allocation. I think once you start getting too emotional with it, you might see yourself going back and forth, and that's kind of the thing you don't want to be doing, is come up with the philosophy you think makes sense and just hold that as long as you can. So
in finance, typically when we talk about risk, we think about volatility, which is the Chicago-based definition from the 50s and maybe even before that. But risk is not only volatility from the individual perspective of the single investor. Which are, in your opinion, the main kinds of risk an investor should be aware of?
So I think volatility is what I would classify as like short-term risk, and that's just like, hey, this is the risk that an asset or portfolio kind of declines within, let's say, the next 3 years. We'll say that's short-term, right? 3 to 5 years. I think the other type of risk that people don't think about is the long-term risk, which is holding, for example, too much cash and you're not investing. I think the risk of not investing is just as bad as the risk of investing too much. I think you just don't see them right away, right? And I think that the difference, if I were to provide an analogy, is like the difference between, at least what the data shows on smoking cigarettes versus doing something like heroin. Heroin is like the short-term fast risk. People that do a very hard drug, they can overdose and die quickly, right? With heroin, meth, whatever, you can put any one of these hard drugs in there. These are the type of drugs that can kill you within a year, right? Smoking is not going to kill you within a year, right? But if you do it for a very long time and very exacerbated, and this is not true of everyone, but on average, right, very long term, lots of smoking over the course of your life, that does raise the long-term risk of like cancer and things like that, right? So, and this has been proven. I think that is like kind of the long-term risk. And that's so I think holding too much cash is like smoking, and owning too many risky assets is more like a hard drug, right? And so thinking about that's kind of how do you balance your portfolio to kind of do neither of those things, right? And so you want to have some cash, of course, you need emergency fund, things like that. But at the same time, you don't want to just have, I know I know individuals in the United States that have literally all their money in their checking account. And they may have like $100,000. That's a lot of money just sitting in cash. And just every year it's being, inflation's eating it alive, right? 4% a year, 3%, in the last few years. I mean, in 2022 is 9% on an annualized basis. Like, you're paying a toll, and it's brutal. And so you need to make sure you're not doing that as well. So those are the two risks you're trying to balance, short-term versus long-term. And so you want to try and find a way to balance both of those as best you can, right? And that's where, the type of risk you take moves around.
Yeah, I suppose it's a mental accounting problem, because if you have a $100,000 in your bank account with inflation out there at 9%, you basically lose $9,000. But it feels different, as if you really lose $9,000. So generally speaking, people fail to immediately understand the equivalence of the two things, because a loss is twice as much painful than a gain, according to the prospect theory. And this leads to very common mistakes in the typical investor's behavior.
Yeah, exactly. And so I'm glad you brought up prospect theory. So that shows like the type of risk people tend to react to is the short-term risk, but you need to think about the other one as well. So kind of balancing that in a way where you take, okay, I'm taking some long-term risk, but maybe not as much, or maybe slightly more long-term risk than I'm taking short-term risk, given the pain thing you discussed.
Going forward, are you more afraid of inflation risks or recession risk? The world is changing. We are going to be coping with a less globalized world, with a higher debt, somewhat different rules of the game. Seems like the economic environment as a whole is changing from what it used to be from World War II onwards. It feels like we are approaching a new era, and it's difficult to forecast what future challenges are coming and how to be prepared.
That's true. I mean, it does seem like we're entering kind of a new, like a regime shift of sorts, especially given since Trump has taken office in the US, that's changed up trade policy. That's going to have ripple effects. Of course, everything's still playing out. And so I don't know what's going to happen, obviously. If you are worried about these things, there are, stocks are still one of the best inflation hedges. And like, there's a lot of data on this. There's a great book called Wealth-Worn Wisdom by Barton Biggs. And he looks through kind of the history, especially during World War II. And he says, hey, like, if I have to pick like what, looking through like some of the worst periods where people lost a lot of money and all these things and because of war and destruction and all that. And he looks through most of Europe and he says, hey, my final recommendation is you should have like 70% of your portfolio in some sort of basket of global equities, right? And then you might have a quote safe haven, which is like a farmhouse or a place where you can go if a war breaks out and you can be safe. So he throws that out there. He says, maybe a little bit in gold, and he makes a handful of recommendations, but he says the bulk of the evidence shows that stocks, equities are the place to be, because these are businesses. And yes, if prices rise, they pass those on to consumers, right? And that's just how businesses work. And so those relative things will shift, but they will pass on those costs to consumers. And that's how it plays out. Of course, that's not a good thing. I'm not hoping for inflation. I think inflation is generally destructive. At the same time, like, we have to have a little bit of it. I think that's probably, a 2% inflation target is probably the right way to go about things. I think deflation is not the way. And I also think hyperinflation or high inflation is not the way either. So stability is usually a thing that brings about the most peace and prosperity. And so I'm just hoping that, we keep inflation low, and a lot of these fears that people have are just fears. And I hope they don't come to pass.
When we had William Bernstein here, he made a similar point about the hedge function of stocks, and he mentioned the case of the Weimar Republic in Germany with a super hyperinflation between the two world wars, and the fact that actually stocks worked wonderfully to protect from prices skyrocketing. My final take after years of studying finance is that stocks work because people always have a good reason to think they're not going to work any longer.
Yeah, that's a fair point, right? If people think, oh, hey, stocks are done now after, a few hundred years of generally working, especially, let's say, the last century, then, and I'm saying globally, I think stocks globally have worked. It's very easy to talk about the US. The US has been an outlier. I'm not expecting, global stocks to grow at 7% per year after inflation. That is an outlier, and that's what the US has done, but I'm not expecting that. But even if you're expecting, 4% per year inflation adjusted growth for a global basket of stocks, I think the data does support that. And that does include Europe. And I've written on Europe and Italy and Poland, all these different countries where, yes, there have been difficult periods for all of these stock markets, but You have to try and be diversified. I think historically you couldn't do that. If you were an Italian investor in the 1950s, it was not super easy to buy US stocks. Today, it's much easier. And so I think that's the kind of the key difference, is being globally diversified, even no matter where you are. Like, I would say the same thing if I was an Italian citizen or a US citizen or living somewhere else. I think you need to be globally diversified.
Yeah, I think it's a great point, because there's kind of oversimplification about the idea of the US exceptionalism. Actually, the US stock market is not even the best performing of all time. For example, the Australian stock market or the South African stock market delivered better results. And if you consider some European markets, they did pretty well too. Obviously, we are talking about it today in 2025, after 15 years, that the US stocks beat anything else. But this same conversation 15 years ago would have been very different. So over time, I think that the different stock markets tend to deliver comparable real results within a range of a couple of percentage points, but maybe it's not that relevant over the long haul, and being globally diversified matters much more.
Yeah, I guess we have to wait and see, right? Because who knows? I mean, there are arguments to be made why the U.S. has had a higher return. I think there's cultural reasons. There's a host of other things as to why why people work more, and all these different things that could lead to that. But at the end of the day, I do believe in a diversified basket, even if that means I'm going to underperform U.S. stocks. I'm fine doing that, because I don't need that extra 1% to reach my goals. I don't think most people do. I think you're either going to reach it and be fine, or you're not going to reach it at all. And so I think there's other factors in your life that are more predictive of whether you reach your financial goals than necessarily the return. So something to think about. It's very few people like, oh, if I just had 1% more, I would have completely reached my goals, right? I think it's like what ends up happening is just there's a big divergence that's based on other factors, like your income, like your spending, all these other things, which would matter probably much more than what your portfolio is generating.
Yeah, life is not in a spreadsheet.
Yeah, exactly. So
one of the reasons why I love your writings is because while you talk a lot about money and finance and portfolios and investing, they're clearly not the end goal, but a means toward a more fulfilling life. Give us your best piece of advice to make finance useful, to make our life better.
Yeah, I think the main thing to think about here is, what are you going to do with that money? I mean, at the end of the day, if we think about what is investing, let's just, in the most abstract, simple way possible, you're giving up consumption today. That's your money that you don't spend on something, and you invest it for the hope that it's worth more in the future. I mean, in inflation adjusted terms, you want a real return. You want more purchasing power, right? So that's the idea. That's why people do it. Otherwise, there wouldn't be an investment industry. So they do that to have more purchasing power in the future. Now, the problem is a lot of people create that purchasing power, but then they don't purchase anything with it, right? They might just keep investing. And there's a lot of data on retirees in the United States, right? So people in retirement older, where 4 in 7 retirees, with all the money they get from their investment portfolio, they barely just spend kind of what their portfolio earns them. They don't pull down the principal. They actually don't spend the principal. So if they have $1 million portfolio, and let's say it's generating 4% a year in income, $40,000, like, they will just spend that $40,000, and that $1 million will stay there. And actually, even more will kind of let that, it'll keep growing actually. So they'll spend usually even less than the $40,000, right? Because in the United States, we have Social Security, which is our government paying us money. So you have that income stream plus your portfolio. So together, most retirees don't even spend their principal down. They don't even spend all their investment income. They end up taking their money and reinvesting it. And one other thing related to this, in the United States, we have something called required minimum distributions, RMDs. And all that means is once you get to a certain age, the government forces you to pull a certain amount of money out of your account so you can pay taxes. They're basically saying, we need our money. We're the government. We need you to pull some money out so you can pay us, right? And many retirees pull their RMD and then they don't spend it on themselves. They end up reinvesting it back in the markets, right? So it gets to the point of like, I get investing. I get people do it. I understand why people do it. But I think it's easy to forget why you're doing it and just focus so much on the money. And then by the time you get there, you're like, I have this money and I'm not going to even spend it. So what was the point of doing all of that in the first place? So how do you live a fulfilling life with all this personal finance advice? Like, go and do the things you want to do. Use your money. I'm not saying spend all of it and go to zero. No, I'm not saying that. But I think there is kind of this idea that people should spend probably a little more as they get older, and they should really try and enjoy those experiences that they've always wanted, whatever that means. And so I generally tell people to probably need to, especially if they're incredibly wealthy, like they probably need to be spending more, right? This is not a problem for everybody, but I think that's the point of money, and you need to do that. You need to kind of follow that.
Maybe it's because you train your brain for your entire life to spend less and to save and invest. So when it's time to enjoy the fruit of your sacrifice, you simply cannot do it because you are not accustomed to it.
No.
It feels like a sin to spend your own money.
Yeah, no, I completely understand that. It is very difficult to flip that switch because usually the people that are very good at saving are not necessarily good at spending. And so kind of flipping that switch is very difficult. So I say, do it over time. Like as you're kind of going through your life, as you're building wealth, start to spend more. My spending has gone up. Thankfully, my income's gone up over time. But as my wealth's gone up, my spending has gone up, and it will continue to increase. And I know it will continue to increase because I want to do more things. I want to, see my family more and do stuff with my family and, travel to different places. And I'm willing to spend that money because, like, what's the point? Why am I doing all this? Why am I writing books and doing all this and trying to help people and all this stuff? And amassing this wealth if I'm not going to use it. Like it doesn't make sense to me. So
last week you wrote a great article about the retirement rules for spending and the safe withdrawal rate and other related topics. I don't remember the exact title, but the idea was a better way to spend your money during retirement. The starting point was the 4% rule from William Bengen.
Mm-hmm.
Do you think it's still valid today, or should we think about our retirement portfolio differently from the FIRE idea, the very basic idea of having 25 times your annual spending in your portfolio to be okay?
I think it depends. And I think the 4% rule is great. I think it's a great starting point because it's like the default advice and it makes sense and it's historically tested and it still holds. And I think Bengen actually just came out and said now the 5% rule would work. So he's pushing a new, 5%, 4%. Yeah. So this is like a new thing he's doing. But regardless of that, I think it's a great starting point. But the question is I think every person is going to be a little different because it depends what's going on in your life. For example, if you have income from the government, if you have Social Security in the United States or any sort of, a pension of some sort, that changes the calculus a little bit, right? Because then you're like, hey, I need this much income to survive and live my life in retirement. And if the government is, let's say, paying for half of that just by the money I'm getting, then I only need less. And so then you can say, okay, I only need to do the 25 times that smaller amount, not 25 times my entire spending need, right? So thinking about those things is important and kind of how that's going to evolve over time. And so I don't think it's the perfect rule, but I think it's a great starting point. And there's a lot of other rules you can use that might be better for you, right? Because the 4% rule is a little too fixed for me. Every year I increase it by inflation and I spend more. What happens if at least they show that at least on average in retirement, your spending tends to drop by about 1% per year. So maybe your first few years of retirement, you spend a lot, you go and do a lot of travel and stuff, but then eventually what happens is you start, your health, it's harder for you to travel. Your life can change in ways that you won't predict. And then you're not going to want to be spending as much money. You don't want to go out and deal with all the stress of that. And so a lot of people end up spending less as they get much older. So, and then obviously until healthcare costs come in, at least in the United States, I know the healthcare system is much better in Italy in terms of payment and stuff like that. So in the US,
I wouldn't be that sure.
That's what I've heard.
I know some people that would disagree.
Well, that's what I've heard. I've heard that at least the payment system is much better. In the US, it's incredibly expensive. So that's what I meant. I didn't mean I don't know a lot about the Italian healthcare system. I just know in Europe in general, health outcomes are better, and that's kind of the idea there. So, but yeah. So I think those are the things to kind of think about is when is your spending going to change and how it's going to change in retirement.
You make me think about a recurring topic in your writings, which is health. You always talk about the importance of staying healthy as a powerful tool to enhance your financial situation as a whole. In your latest article put out recently, you made the great point about making exercises if you are late with your retirement plan.
Yeah, and I think this idea is like, oh hey, let's say you're trying to catch up. You haven't been saving a lot. Let's say you're in your mid 30s, mid 40s. You haven't saved a lot of money. The traditional advice is like, okay, you got to work extra hard and catch up and like save more money. And my advice is a little bit different. It's a little I don't want to say controversial, but it's just different from the standard advice, because I think you should actually really focus much more on your health so that you're healthier for longer, so that you can work more to catch up. So if you, the first 10 years of your career, if you didn't save any money, if you stay healthy, you can add an extra 10 years to your career on the back end to make up for it. And health is a good thing regardless. I think this is a good thing regardless of the financial implications, but I think there are positive financial implications as well. So it's a win-win. You're going to be able to save more money, which is going to make it easier for you in retirement. And then you're going to be healthier, feel better, etc. I think those are a lot of the things, but you got to put the time in, right? There's no shortcuts to this. I wish there was a pill we could all take, but it just doesn't work that way. You have to actually go and train your body. So it's something to think about.
Besides Just Keep Buying, which is obviously a one-stop shop to become a better investor, is there any other book that you would recommend that had an impact on your development?
Yeah, there's a few I can recommend. So you brought up William Bernstein earlier. He's probably one of my favorite investment authors. His The Intelligent Asset Allocator. I love that book. That's a great one. It's a little more technical, but it's really good. I love Ben Carlson's A Wealth of Common Sense. It's just a book that it covers just about everything, right? And so, which is really cool. So you can kind of get a little bit of everything in that. And then I also loved Your Money or Your Life by Vicki Robin, which is a little bit more on the personal finance side, but it's just this idea of like, at what point do my assets start paying for my lifestyle? Do all my investments pay for my lifestyle? And it's thinking about that. And there's something called the crossover point, which she talks about. And I think that's very helpful as well. So those are a few I would recommend. The Intelligent Asset Allocator, A Wealth of Common Sense, and Your Money or Your Life. Those are three just great books. And there's so many great books out there. If you give me more specifics, like, oh, I need a book on budgeting, then I would say, Get Good with Money, Tiffany Aliche. If you have a different type of book, there's so many. Once you go specific, I can then pick books out, but there's just general ones I would throw out there.
2 out of 3 were guests here at the Bull, so thank you for mentioning them.
Yeah, of course, anytime.
Tell us something about the Wealth Ladder, your latest effort.
Yeah, so when I wrote Just Keep Buying, my idea, as you said, it's like a one-stop shop. I was trying to just say, if I know nothing about you, what advice would I give? If I have no information on your background, like what's the best advice I could give you, right? And so that's what Just Keep Buying is, right? The continual purchase of a diverse set of income-producing assets, right? In terms of how to build wealth, what's the best advice? That's it. With the Wealth Ladder, I said, what if I know something about you? And that one thing I know about you is your current wealth or your wealth level, as I talk about in the book. So I know kind of a range. You're in a certain range of wealth, right? So there are 6 levels of wealth as I define it. Level 1 is less than $10,000, or you can just say euros. It doesn't matter. Less than 10,000 euros. Level 2 is 10,000 to 100,000 euros. Level 3 is 100,000 to 1,000,000 euros. And it goes up from there. Each level is just a 10x jump.
You mean net worth?
Yeah, net worth. I'm sorry. Yeah, so when I say wealth, I mean your net worth, which is all of your assets minus all of your liabilities, right? So everything you own, your car, home, etc. Subtract out any debt, credit card debt, if you have student loans, etc. So you net all that out, and that comes to a number, and that's going to be in one of the 6 levels, right? And so given that, if I know what level you're in, I can provide better advice. I can say, hey, you're in level 3. You have anywhere from 100,000 to 1,000,000, let's say, euros in wealth, or net worth. In that case, you should follow this strategy, right? But if you had less than 10,000 euros, you should follow this strategy, or you should focus on this more. And so that's the idea. With Just Keep Buying, I tried to provide this one-stop shop. With the Wealth Ladder, I'm kind of zooming out and saying, okay, if I know your wealth, then I think I could provide even better advice. And so it's just trying to be a little bit more specific and just kind of be, cover the big picture at the same time. So I think that's what my goal was. And so ironically, the advice, the strategy I give in level 3, which is 100,000 to 1,000,000, let's say euros or USD in wealth or net worth, the strategy is Just Keep Buying. I think that is the strategy for those people. Like if you want to go into that level or kind of get to level 4, which is 1 million to 10 million USD or euros, the strategy is Just Keep Buying. It is that book. But that strategy is not the strategy when you're much lower on the ladder, and it's not the best strategy if you want to go past that. If you want to go past 10 million euros, just keep buying is great, but it's probably not going to be the thing that's going to get you there. And I discuss why that's true as well.
Interesting.
So,
look forward to it.
I appreciate that.
Nick, thank you so much for coming here. It was a real honor to host you in my podcast, and I can't wait to meet you again in Milan when you'll be back. A little part of you belongs to Italy, so you have to come back once in a while. So we'll be waiting for you.
Yeah, thanks so much, Ricardo, and I'll definitely come back. We'll have to get dinner again. So thank you. Thank you so much.
Wonderful. Bye-bye. And that's all, folks. Thank you from the bottom of my heart for celebrating the Bull's second anniversary with me. I truly hope to have you all here again, and possibly an even bigger crowd on June 2026 to celebrate another trip around the sun for our podcast. And of course, a big thank you to Nick for accepting my invitation and for everything he does week after week to bust financial myths and show us a smarter, more grounded path to investing and building a fulfilling life. As always, I encourage you to follow the show and turn on notifications on Spotify, Apple Podcasts, or wherever you are listening. And if you enjoyed this episode, please consider leaving a 5-star review to support us and help us keep creating content that, in the end, all circles back to one message: just keep buying. That's truly all for today. I'll catch you next Sunday for another episode right here, as always, on The Bull, your personal finance podcast.